Hello, everyone. Welcome to the Exceptional Advisor podcast. I'm your host, Sean Walters. This is put on by the Investments and Wealth Institute. We try to feature ideas, trends, and thought leadership facing the advice profession. Today's guest is Michael Kitces. Welcome, Michael.
Hello, Sean. It's good to join you. Appreciate the opportunity.
As most of you listening know, Michael's one of the most recognized voices in the industry. He and I have a long history together.
Like 20 years now.
Yeah. I was managing director back at the Financial Planning Association. We worked on conferences together. He was integral in starting the Next Gen community, which I had as part of my group as well. When I came to the Institute, he taught in the Certified Private Wealth Advisor certification, Retirement Management Advisor certification, lots and lots of conferences. So we've stayed close throughout, Michael, and it's been a pleasure to watch you grow and all of your businesses grow and thrive. So thank you for joining us.
Thank you. Likewise, it's great to see CPWA RMA continue to grow, having been with them for when they were very, very new and very, very small. I know you got that whole SEMA thing as well, but I suspect we'll talk here. A lot of this discussion now is, where does the value sit in the future, and how much is investments and how much is wealth and how much is retirement and all these other domains that we do work in as advisors.
I know how it is when you and I get together and usually have a well-scripted podcast script. But for you and me, I only have really 3 topics, and I'm going to position them for us as this or that.
Okay.
But I suspect the conversation will be a bit of this and that.
Yeah. I usually like to parse my answers that way, but sure.
Exactly. On the one hand, on the other hand. And you're a great economist that way.
Yeah.
So
just don't say a price and a date in the same sentence. I've learned how it works.
Yeah. So we'll talk about investments or wealth, solo or team,
Okay.
utopian or dystopian. That's what we'll close with.
Oh, okay.
So first up, investments or wealth. That's kind of our name as an organization. We serve both sides of it. I'm kind of curious your take on, in terms of bodies of knowledge, which one is important and why, and maybe any other thoughts you have on it.
I still really am in the camp that I think both bodies of knowledge are important, but that they are more separating relative to the role of what you do or don't do as a financial advisor. Right. I mean, if we go all the way back, I'm 26 years in now. You pick the funds, you make the portfolio, you meet with the client, you get the client, you service the client. Everything was all in one. And ideally, you're trying to get higher dollar clients over time. So wealth and investments and planning and advice and business development and servicing, everything was in one big jumble that it meant to be a quote financial advisor. And to me, I think there are a few things that have shifted to me sort of structurally and strategically in the landscape over the past 10, 20 years. The first is, as firms have grown, investments increasingly have centralized, which means from a day-to-day life and a service delivery perspective, even if part of my value prop as an advisor representing my firm to my clients is that we, air quotes, do investments, it doesn't necessarily mean I personally pull up my sleeves, put my hands on the keyboard and manage your portfolio one typed trade at a time, right? This is increasingly not only the realm of technology with rebalancing and model management software, but something that frankly a lot of our firms have found is very conducive to centralized and scalable growth. I can have one trader for lots of advisors or a standard set of model portfolios. And so big firms often have centralized house management and house models. Independent firms are increasingly building out their own investment teams. And so what that means to me, at least relative to, I think, our audience and discussion, Sean, of as the end advisor, to me, there was a very investments and wealth and literally what we did in our day-to-day lives in our businesses. And that increasingly is becoming a function where maybe the firm does investments and wealth, but I, as the advisor, probably just do one or the other, right? Some of us are investment nerds. We love to roll up our sleeves and get into the investment things. So we get the investment designations. We might have a more internal facing role to the portfolio, then an external facing role to the client at this point, but we do the investment things that we want to do and pursue the specialized knowledge that's there. Or I become more client facing and more wealth oriented in the advice that I'm delivering, in which case now I'm pursuing knowledge and education in the direction of wealth more so than investments. So at the firm level, it's an and, but to me, at the advisor level, it's increasingly becoming an or, because you can't do everything, and turns out it's not even terribly efficient for the firm to have you try to do everything when many of these things can be centralized, systematized, better scaled, and better delivered with technology.
Yeah. So one question as a follow up on that, or thought, where I'm curious. You serve a lot of younger advisors that are kind of getting started, looking at career paths, how they best fit into the advice patchwork quilt.
Yeah.
We've seen our certified investment management analyst (CIMA) candidates get younger and younger, kind of closer to that CFA candidate age. So maybe there's two questions there. One, is there a role for young professionals who maybe don't want to be in front of human clients, who want to sit in their home office and work on their laptop and evaluate managers? Is there still a role for them to play in the profession of the future? And then my second question I was ask you, which is CFA or CIMA in that regard. So
Yeah.
go for it.
So I do very much think there is a non-client facing role to play, and I would actually argue there is more of one in the advice profession today than where it was. I'll sort of generically pick on, like, call it 20 to 30 years ago, like the 90s, 2000s. Much of this, I think, is a function of how the business model has changed, and it's important not to lose sight of that. If I go back 20 or 30 years, most advisors were mostly commission based. And that was just a business model. Like, I sold insurance, I sold mutual funds, maybe I still got paid to execute stock trades. I was just barely on the end cusp where I could still actually get paid a decent amount of money to literally take a phone order and place a trade for a client. So commissions pursuant to transactions was the model. And what that means from a business end for an advisory firm is basically there's only two types of roles that tend to exist in transactional commission-based firms. The people that go get the revenue, and admins to support the people who go get the revenue. And there's really nothing in between. Like, you were a producer or you were the admin to a producer. And that was basically it, because no one in the firm is making money unless the producer is out there producing. And if your revenue goes to zero every January 1st until you get out there and see clients and get business done, you don't carry a lot of overhead. You don't carry a lot of staff salaries, or you have the advisory firm equivalent of Black Friday, where you have to work 10 months of the year to pay your staff salary, so that the last 2 months of the year, you're finally profitable. It just doesn't work. And so teams were tiny, if there was any team at all. Support from a firm was a purely admin function. And basically, even that tried to be minimized because it wasn't cost effective unless it was absolutely necessary to get a producer to be out producing more. As we've shifted to an AUM model and now a subscription fee model, broadly speaking, I'll say recurring revenue. At some point, as an advisor or a firm owner, you wake up on January 1st and you've got 10 million, 20 million, 30 million, 50 million, 100 million, 500 million, a billion, several billion, whatever the number is as it grows. You've got some base of assets and some sizable chunk of revenue already booked on January 1st. All you have to do, in air quotes, all you have to do is give the client great advice and great service so that they stick around and continue to engage. And once you hit that point, a whole bunch of things start to change in really material structural ways for the firm. Service advisors and associate advisor roles appear because there's a real job with actual revenue attached to it to give great advice and service to clients and do great planning for them that has literally nothing to do with business development. Service the revenue is profitable. Get more clients that grows the business, and we often want to do that as well. But in essence, service and sales split, which means a whole bunch of service advisor and specialized roles evolve. Then as those people need to be scaled up, centralized planning departments start to appear. You get directors of financial planning and a financial planning team. The same thing happens on the investment end. Why would every advisor do their own trade when we can centralize the trading team, or better yet, centralize the investment research to have a standard set of models that all clients have with a reasonable range of choices so that we can still align to their goals and needs? And then all of the trading function is centralized as well. And so the advisory firm of 20 years ago was producer admin, producer admin, producer admin, and a manager to make sure that the producers were producing. I like that. I mean, that was it. And a modern firm today, as it grows and scales, has advisory teams, teams of teams, increasingly centralized ops, increasingly centralized planning, increasingly centralized investments. And so what that creates is a whole slew of specialized career tracks, which means you can be an advisor who loves serving but doesn't want to do business development. Or you can be a planning or investment specialist who doesn't even want to see clients.
Yeah.
And all of those jobs exist in a way that they didn't, because that's what happens when you go from a transactional revenue where dollars start over on every January 1st to a recurring revenue model where there's dollars there on January 1st. And it creates just a very strong natural incentive for the firm to literally reinvest into team depth and staff development. And when you do that as the firm grows, what you get are career tracks, like real do this, move
Yeah.
to this, get promoted to this, real career tracks and a progression path for people to follow coming in. And then you essentially just get to choose your own adventure story. Like, are you an investment nerd? Cool, we have an investment team. Are you a planning nerd? Cool, there's a financial planning department. Like serving clients? Great, we've got a service team. Like doing business development? Here's what you need to hit partner. Like, and all of those paths come forward, and people who come in get to choose, which to me is part of how I think ultimately we're going to help solve what the industry claims is a talent shortage. And I don't think it's really going to play out that way, because the reality is we have so many more jobs and career tracks for people who to come in. The shortage problems were 20 years ago when, there were two types of advisors: good business developers and ex-advisors. And there was nothing in between, because if you couldn't hunt enough to eat what you kill, you didn't have a job. And that's
Exactly.
not really true today, or it doesn't have to be.
Well, and that's you're definitely answering the second theme where we're going to talk about a little bit more in a moment, solo versus team. But just that follow-up question, if you would double click that. So within that investment team, that specialist team, what's the role of a CFA versus a SEMA in your mind?
So as I look at the two, to me, CFA's strength at its core is the analysis of individual securities, right? Stocks and bonds. I actually started the CFA route, shifted as my career shifted, and went and got a tax degree as well. But I'm like, I remember going through and passing level 1 of my CFA and like being able to calculate the dirty price of a bond on it with a financial calculator by hand. And I'm not even making light of that. Just like if you are going to do individual bond analysis and selection and purchasing, you need to know enough about exactly how a bond price is calculated on the spot, so that in the modern era, if you're like looking at bond prices on a screen, or you're getting quotes from the desk, like you can actually spot, am I getting a good trade? Am I getting a good price? Am I getting good execution or not? Hey, here's an anomaly we should take advantage of on behalf of our clients. Or, oh, that looks mispriced. We are definitely going to avoid that, right? There's a real value, incredible value to that knowledge. But it really, to me, that strength comes down to when you're analyzing and buying individual securities. If you live more at what I characterize as the portfolio management level, not that buying individual securities doesn't comprise a portfolio, but when I mostly think in terms of how am I asset allocating a portfolio, how am I designing a portfolio in the aggregate, and particularly if I'm using more or a wider range of vehicles than just individual securities. Yes, the CFA covers some of that, but to me, that's where SEMA tends to sit more effectively, because it's really built for that and just frankly doesn't layer you with a lot of individual security analysis things that, if you don't actually pull out balance sheets of companies and their cash flow statements, are just really not going to be useful to you in practice in a CFA curriculum. So I view them as different because of the level, a level in depth and the focus of where they are. And so does that fit or not for a firm? I think that depends on literally like what you do and where you're positioned or what the firm's value prop is, right? If I'm running a mutual fund and we buy individual securities, like I hope to see a whole bunch of CFAs sitting there. If I'm an advisory firm that likes doing individual stock and bond management, which many still do, I'm probably looking for at least some CFAs to be on that team. If the firm is more tactical or strategic or asset allocating or focuses more on how are we allocating amongst lots of different vehicles, not can we pick the right stock, now I start looking more towards CMAs. I think there's also some crossover relevance. I can still see worlds where if you are an advisor at an investment heavy firm that needs to have a lot of investment conversations with clients and prospects, there's some value for SEMA in investment fluency to be able to talk to your clients, or at least say like your engineer clients who want to nerd out on it because the rest don't want to hear trainer ratio ever come out of your mouth. But there's a subset of advisors in very investment oriented firms where I think SEMA also has some useful crossover that, if you've got a CFA and that was your background, like more power to you. But I wouldn't really tell a young person, like, go get a CFA so you can talk investments with your clients. Like that is several years of exam overkill relative to what you're really probably going to need in front of your clients. So I do think there's relevancy for both, but they show up in different types of firms and structures. So make sure you're matching the designation either to what the firm's investment process and structure really is, or failing that, just like what direction you want to take your career. If you're young and looking and saying, I really like this, and maybe this firm isn't a fit for me, but I want the designation that gets me to where I'm going, pick with that in mind.
Yeah. No, I mean, that's great advice, Michael. And this, so the next segment is so interesting. You and I both, give or take maybe 5 years, and I grew up in the financial planning industry around the same time.
Yeah.
And we've seen this profession go from kind of a solo advisor to a real business model, or from a vertical. You were talking earlier about a vertical team to more of a horizontal team structure. So I think I know the answer to this, but you also serve a lot of advisors and counsel a lot of advisors who do just want to do their business by themselves. And so this question of solo or team, I'm sure you've got a this and that type of answer, but what's your take on solo or team?
Yeah, I literally live like both ends of this at the same time. I am head of planning strategy for Focus Partners Wealth, which is, one of the big mega RAs that's like many tens of billions of dollars and hundreds of people at the firm and all the teams and all the structure and all the systems and all the fancy tech. And I'm a co-founder for XY Planning Network, which literally helps solo advisors run and launch firms entirely from scratch with less than $10,000 in the bank and get going successfully. So I think the reality is it really is a both thing. And I don't say that just like be evasive around the answer and not picking a choice. Like it really truly is a both phenomenon. And I look at this even relative to the broker-dealer industry and how it evolved over the past 30 years. So if you go back to 1980s, early 1990s, like the big shift was if you were an investment person, you worked at a regional or national broker-dealer, aka wirehouse. And then this new thing came along. They called it an independent broker-dealer, where you weren't a W-2 employee on the payroll of the firm that, gave you like a 40-something% payout because they handled all the infrastructure and costs and office space and team and all the rest. It was this independent thing where they might have paid you 85 to 92%. They just covered compliance, tech, a little bit of community layer, but basically you built and ran your own thing. And, people on the independent broker-dealer side of the business said, like, we're the future and this is where it's going. And the large firm wirehouses said, y'all are nuts. We've got all the budget. We can make the better technology. You have no budget. You can't make any technology. We're going to win. And so you fast forward this now over 30 years. And to me, there are a couple of interesting things that play out. For all the discussion of breakaway brokers and the wind down of wirehouses, there's still roughly 50,000 advisors at wirehouses. And when we talk about the breakaway movement of like all quote unquote, all these advisors are leading breakaways, if you look at the industry statistics, the big debate is whether it's like 100 advisors broke away or 200 advisors broke away. There's 50,000 of them. So like our grand debate is whether 0.2% of people left wirehouses or 0.4% of people left
Exactly.
wirehouses, which is a nice way of saying the people who are there value the team, the infrastructure, the systems, and what's there. And they're quite happy in that environment. And if they're not, they're the ones that leave and go to the other side. The folks on the independent side are very happy being independents. They want to build their own teams and build their own infrastructure and control their own stuff and just kind of rent the parts of infrastructure they need by paying a percentage to a platform that they affiliate to. And they control their own stuff and build their own outcomes. And they too seem to be pretty happy and don't go the other direction. And so when I look at a world where I say, okay, there's mega firms that have all this infrastructure and there's independent channels where you build all your own infrastructure and there's almost no crossover between the two in either direction, really, what that says to me is, yeah, some of us just like being in structured team environments where someone builds all the stuff and you can just go and serve your clients. And others of us like to roll up our sleeves and build our stuff from scratch. And
Yep.
I think now you're seeing the exact thing play out in the RA channel. So if you go back again, the way it used to be is we had this spectrum. There were wirehouses where you were employee, regional broker dealer where you were still an employee. Then maybe there was like a statutory W-2 structure where you were a little more quasi-independent. Then there was an independent broker dealer where you were mostly independent. And then there was an RIA. It was like the most independent extreme end of independence. It was like, okay, you got all these choices, but if you're one of those stubborn people who wants to go like roll up your sleeves, claim your plot of land, chop down the trees with your own axe and build your own log cabin, go be a pioneer. And I mean, those were the RAs, Sean, like when you and I were starting 20 something years ago.
Yep.
But when I look at the RA environment today, so I can still go and do that and just literally hang my own shingle and build my own log cabin. But I've got networks that I can affiliate with that provide some infrastructure, right? Everything from, we do a version of this XY planning network for firms that want to be planning oriented. Dynasty does a version of this at the other end for firms that are building much, much larger team structures, but they still want to have some chassis to attach to. Then we've got corporate REA affiliate models that are very akin to the independent broker dealer model. You're mostly on your own, but you pay a percentage of your grid, as it were, a percentage of your revenue to get the compliance and the tech and the basic infrastructure, same things that IBDs often provide. And then you've got various employee models, all the way up to mega RAs with restrictive employment agreements, remarkably similar to the restrictive employment agreements that wirehouses had 20 years ago. So to me, all that you're seeing happen now is because there's just this human range that some of us want to be in structured environments where we can just do the client things we want to do, and others of us really want to have more control and autonomy over the way it's done. And I want to serve my clients the way I want to serve them. Darn it, I just don't want anybody to tell me to do otherwise. The RA channel is now reinventing the same spectrum from employee to
Exactly.
full
Yeah.
independence that has existed in the broker-dealer model for 30 years. And now you get the full range. You can do teamy things if you want to do teamy, and you can be solo if you want to do solo. You just get two choices now. I can be team versus solo, and I can be FINRA versus not FINRA. Because if I only want to manage portfolios and give financial planning advice, I don't need the FINRA license. So I can switch channels, but I don't necessarily have to switch team versus solo infrastructure. If I liked being flexible in an IBD, I can go find a corporate RIA or a network structure as an RIA. If I like employee models that have the brand and the infrastructure of the rest, I find a mega RIA platform that's able to do that as well. I think the piece that gets lost in the industry dialogue, though, these days is there is a little bit of kind of talk your book from the mega firm perspective that you cannot survive without large firm capabilities and scale, which is basically a nice way of saying you're going to die without us, so you may as well sell yourself to us, which is great because we have a lot of PE money and we'd like to buy you. And I think there is some of that dialogue happening because they're trying to convince people that they can't survive on their own because they want to acquire them.
Yep.
When I actually look at like the benchmarking studies and the research that we do, like the hard dollar reality is it has literally never been more profitable and easy to be a solo advisor.
Yeah.
Because
I
I
mean,
used to need a bunch of staff for, now I just buy like a bunch of $49 apps and I can run ludicrously profitably as a pure solo advisor.
He'd be a good guest for your podcast too, but I'm trying to get Mark Cassidy
Yes.
on our podcast. He had a quote in our last article on AI, or last
Yeah.
issue in Investments and Wealth Review, that the RIA of one, he sees $1 billion RIA of one in the future. So that kind of gets into our last topic, which is
Yeah.
utopian or dystopian future. And obviously we could spend a whole episode on that.
Yeah.
But I'm just curious in general, if you look out 10, 15, 20 years into the future, how positive are you?
Yeah.
What type of industry analogy will we be? The insurance space, the accounting world, or will financial planning and advice be something wholly different than either, when you think utopian or dystopian?
Yeah, I'm still very bullish on our space. I guess on that spectrum, I'm more utopian than dystopian. I mean, I struggle a little with the word utopian because it's still going to be hard. Like, it's still going to be hard. It's still going to be competitive. The space will be more crowded than ever. It'll be even harder to differentiate
Yep.
because more and more advisors are coming in and doing this stuff. You'll have to be even better in your knowledge and capabilities because you have to, if you want to have a job as an advisor, you have to be better than the machine.
Right.
And that's just sort of how it's always been in every job and profession since forever. The more technology comes along, we always have to stay one step ahead of the machines and do the things that the machines can't do. And the machines keep getting better. So as the bar goes up for the machines, the bar goes up for the humans. And that's why, right, growth in CPWA, growth in CFP, like all the designations are growing right now, all the major ones, because I think the advisor community collectively is kind of feeling the pressure of, okay, well, the more the technology, and first it was robo and now it's AI, the more it does that stuff, the sharper and more I have to be on my game to be able to move up and go to the next level. So I don't think it gets like magically easy where the technology creates this utopian world where everything is simple and the outcomes are great. But I'm very, very bullish on the advice opportunity. At the end of the day, there is just a reality that remains that when life gets to a certain level of complexity, people don't want to have to figure it out all on their own. And as much as we talk about how, again, like robo and now AI is going to be able to help consumers do some financial planning on their own, to me, it's like, yes, and most of the people who want to do it themselves online are not the people who hire me in the first place. The people who are going to use AI today are the people who used robo 10 years ago, who used the internet and E-Trade 20 years ago, who used Schwab's discount brokerage dial-up service 30 years ago. Technology has been progressing in parallel to financial advisors for decades. And what happens is there are technology tools that are great for do-it-yourselfers who do it themselves, and there's a subset of people who either don't have the time, have too much complexity, or just have a preference to delegate and don't want to deal with this stuff, who say, I'm just going to go hire an advisor and have them figure this stuff out for me because there are other things I want to do with my time or my life.
Yeah.
And if there's one thing to me that creates a fundamental tailwind for all things advice, it is that despite all the advancements of technology, our lives are not getting simpler. It is not easier to navigate my day. I don't know anybody who gets home at the end of their day and say, thanks to all the advancements of technology of past 10 or 20 years, I've never had more free time sitting home alone after work to like hang out and go on the internet and learn finance things.
No.
I'll hear that from anyone, anywhere, right? So somehow all this technology is amazing and it's just making our lives more complex, more frenetic, and the cognitive load on our brain is higher than ever, which is why we see this world where the technology, including for consumers, has never been better. And the latest Cerulli study was consumer willingness to pay outright fees for financial advice is the highest it's ever been in the history of the profession.
Wow. Yeah, we had a similar survey we just released with Julie Littlechild, Absolute Engagement, on
Awesome.
With advisory clients, and the role of credentials is definitely increasing. To your point, as the machines get smarter, humans have to get smarter as well.
Yep.
And so you're absolutely right. I would echo all your comments on that. I know we kind of had a hard stop at 30 minutes.
Yeah.
I want to make sure we respect your time. I really thank you for joining us, Michael. We could go on
My pleasure.
for quite a while and usually do. This is a great conversation.
Absolutely.
Thank you, Michael.
Thank you, Sean. Appreciate it.
And thank you all for listening to The Exceptional Advisor. For more insights, resources, and leadership from the Investments and Wealth Institute, be sure to subscribe and stay connected. And we'll talk to you all soon. Let's be careful out there.